Greetings. It's another Thursday. I'm so happy to be
You sound like
here.
it. You sound like it.
I don't
We
sound
do
like
have we have a great guest today and some great information to share.
Absolutely. We were talking last week a little bit about being anti-fragile,
Mm-hmm.
and one of our favorite guests is going to be here, the anti-financial planner. So
Excellent. Yeah.
uh, anyway, we'll get to that shortly, right after this. Hello, once again, I'm back. Did you miss me?
Always, Bill. Always.
Thank you so much for joining us on the Real Estate Investor Show. We are Carolina Capital Management. We are lenders in the Southeast for real estate investors. So if you are interested in borrowing money, go to carolinahardmoney.com and click on the Apply Now tab. If you are a passive investor looking for passive returns, click on the Accredited Investor tab. Don't forget to like, share, subscribe, hit the bell, and don't forget to sign up for Wednesdays with Wendy. So Wendy dedicates 30 minutes per person on Wednesdays to talk about anything real estate related. She's usually booked up a couple of months in advance, so get on her calendar. It's on the right-hand side as well as right here on the screen, but in the little chat to the right. You may be viewing from a different platform. It may be underneath the screen, but feel free to ask questions, make comments, stick your nose at us, whatever, in the chat box. It's been a long morning.
Well, yeah, like I said, we have an exciting guest today. As Bill said, he's the what you said, the
anti-financial planner.
I love it. We'll get to that.
Or wealth manager.
Or wealth, yeah, same. But we'll get to that. Do you have some news for us?
Yeah, let's real quick. We got a little breaking news I'd like to add. All right, so this is no secret. Rates are higher. What isn't also a secret that also comes up with higher rates is that mortgage companies right now that are originating loans are, I think it's like 58% of the mortgage companies out there now are not making nearly as much money as they were previously. Well, we figured that out.
Well, yeah, because the rates are rising. It's a volatile secondary market on the on
Sure.
Selling and securitizing these things. Rates are rising so fast. Like you close, like a lot of the lenders, they'll lend on a warehouse line, so they'll close it on a warehouse line and then they'll go place it into a securitization. Well, in the time that they closed it and go to place it in a securitization, the rates on the secondary market have already changed, and the rate that they closed is not nearly what it should be to hit market. So they're having to take haircuts on their margins, or in a lot of cases, losing their margin.
Just so you know, most mortgage companies do not just make money on the origination fee. They also make it in the difference between the rate that they charge and the rate they can sell it for.
Yeah, and there's a premium when they sell it on a securitization as well.
And keeping in mind, they're doing this based on a 5-year hold. So in the past, they were also losing money because rates kept going down and people kept refinancing.
Yeah.
And the people that were buying them from them were getting money back because they weren't holding them for 5 years.
Exactly. Mm-hmm.
So it's not a, I hate to say this, it's not a very profitable business. By the way, it can be, but you have to take it while it's there.
And you have to be able to move quickly and do your best to anticipate what's going to happen in the market and position yourself that if something does happen that you didn't anticipate for, your margins are just reduced, not eliminated.
It just goes to show you that you have to have efficiencies in your business. You can't carry a lot of, we'll just call it dead weight inside of your business. If you're not efficient in the mortgage industry, you are going to lose money. And by the way, the average cost of originating a loan has gone up to nearly $9,500 per loan.
Yep.
That's a lot. And that's just the cost of originating the loan. So while you have the cost of everything going up, you don't have any margin to work with. So you have to, these rates are going to have to go up as well, just for the profit part.
Yeah. And also people who are freaking out about rates right now, relax. It was going to happen.
Yeah.
It's a market cycle. Also, inflation 7%. If your rate is under 7, you're still in a good spot. So relax.
And rates are relative. We keep harping on this. My first mortgage was 14.5% FHA loan. So if you're under 6 right now,
it's great.
You're in gravy.
Yeah, awesome. You want to bring our guest on, or you got anything else?
Yeah, one real quick thing.
Okay.
I want to add to the fear. Not really.
Fearmonger.
So
I love it.
we have little news from Zillow about the housing market. It has doubled since 2012.
Also breaking news. Zillow's poor algorithms led to that.
But basically,
of them purchasing over market.
Basically, what they're saying is, in 2012, when we were kind of at the depths of the housing crisis, the U.S. market has doubled in value since then.
You were like 43 trillion or something like that?
Yeah.
Is the total value.
And then 2021, the appreciation was over 19%. That's a lot. Now,
again, you can thank Zillow.
In California, because 21% of all the home values in the country is California.
Wow, that's it. Wow.
Yeah.
Okay,
that's enough. I don't want Chris just to hang out in the green room eating green M&Ms, because I know he likes to work out and stay trim. So, Chris, Miles, come on board.
I made it. I'm here.
Welcome.
It's good to see you, my friend.
Same here.
Excellent.
What are you telling your clients right now? Just stay the course the way you've been telling them on how to take their income and turn it into active income and turn it into passive as much as you can.
Well, before you answer that, just give us a recap of kind of what you do, Chris, if you would, because I know you're the anti-financial planner. Kind of tell our viewers what your goal is with your clients.
Yeah, I mean, as you said, anti, right? We're in opposition to anything they're doing. And now I won't say financial planner, because all of a sudden someone will say, "Oh, you should have some sort of designation that goes to that, some letters behind your name," which I've been there, done that. That's dumb. So, I'm more of an anti-financial advisor, right? Where I'm teaching people how to go away from the stock market, go away from the traditional saving in your 401ks and your IRAs and paying off all your debt, being that Dave Ramsey poster child in hopes you someday might be able to become financially free. Now, I was that financial advisor 20 years ago, did that for a number of years, but realized none of my clients were really becoming financially free, nor, this was brought up to me too by another investor who said, "Well, how many of the financial advisors do you know were actually financially free, not off the commissions they're earning, but actually investing into those mutual funds?" And when I realized that there was financial advisors working there since the late 1970s, I knew the answer. It's zero. None of them were financially free. And so I realized it's proof. The proof is in the pudding, right? I like evidence. Nobody's coming financially free. The place where I found it, which has worked for millions of us, including those of us here on this show, is through real estate investing, right? Actually doing things in the alternative investment space versus doing it in the traditional financial space, which has been proven not to work. So what am I telling my clients? Same thing. Don't listen to them. Do the opposite, which is focus more on passive income? How do we generate and create passive, recurring, predictable income so that you know what's going on? And I'll tell you one thing I've said recently. You hear people all the time, especially when the world's in chaos and people don't know how to plan, right? Everybody will say, well, I need to create my financial future. I need to get my financial future in order. I'll hear that all the time. And I tell them, no, you don't. What you need to do is get your financial present in order. If you get the financial present in order right now, you don't have to worry about what's going on with inflation. Because if your financial present is in a place where you can actually be financially independent today versus 30 or 40 years from now, which you don't even know if you'll be alive in that amount of time, well, great. Fix it today. You get the financial present fixed, you'll fix your financial future as well.
Yeah, no, well said.
Agreed. The typical model is broken, and I say this all the time. The model is you work hard, you save a particular amount of money that you think you will need when you do retire, and then the plan is to draw that money down because they assume that your lifestyle is going to be less expensive, and then you have to hope that you die before you run out of money.
Yeah, and hope that quantitative easing hasn't inflated, created an inflation monster that has devalued the dollar to a point where what you thought you had to survive on is 1/10 of what you actually need, which happens a lot with people who are putting their money in places that are earning less than the dollar, is inflating.
Yep, that's right. It's such a weird backwards world, right? I get a lot of people that they've done the traditional mindset. For example, and I pick on Dave Ramsey, bless his heart. He's a great man, right? And he does a lot of good for people. If they're trying to get on a budget, they need Spendaholics Anonymous because they can't control their spending, or they're living on minimum wage. They need some sort of discipline. They need some sort of system in order to just get to that finance 101 class, right? That's more like remedial if you do Dave Ramsey's course. The problem is that we got a lot of people, including middle class to upper middle class Americans, following that advice still. And what happens is these people years prior, they're screaming freedom, on their little podcast, saying that they paid off all their debt with their mortgage. And then after years, they're still saving and packing money in their 401ks and IRAs. And then they come to me and say, okay, I'm not free. I'll still have to keep working forever. And maybe I'll have to live on rice and beans for the rest of my life because that's all I can afford. Or, hey, that's even a little bit too expensive. Maybe I eat some ramen noodles. So then my life expectancy goes down. I die faster and I won't run out of money so quickly, right? That's really become the financial plan. And we don't want that. We want to live a life. We don't want to wait till we're 60,000 years old and hopefully have something there. And so these people come to me all the time saying, well, what do we do? I give you an example. I had a guy that came to me. He had $3 million. He actually set up in IRAs and 401ks. This guy's packing in 6 figures a year into his retirement plan.
Wow.
And you know what his financial advisor said? He was 52 years old. His financial advisor said, keep going. And maybe by 65, you'll make it.
Wow.
And this guy had a goal to live on $500,000 a year. That's no small amount of change, right? But I said, man, $3 million right there. Now, $3 million in the traditional retirement mindset. People used to say the whole 4% rule, you live on 4%. Well, that rule has already been disproven. We were talking about tossing that rule out 15, 20 years ago. Well, finally, the Wall Street Journal came out last October and said it shouldn't be 4%. Maybe it should be 3% that you're living on. So think about it. He has $3 million to live on $90,000 a year. And with all the inflation and things going on, that's barely middle-class lifestyle. As a multi-millionaire, he's barely living middle class. If you are a millionaire, $1 million living on 3%, that's $30,000 a year. You're a broke millionaire. You're living below the poverty level. Congratulations. And that's before taxes come out. And so when we switch this from an accumulation mindset that we've always been taught to that passive income acceleration mindset, what happens now, we say, wait, that $3 million, instead of it paying me $90,000 a year, what if I just earned, 8% on that money? That's $250,000 a year right there. And especially depending on where you're investing it, you might even get some tax advantages too.
Sure.
And so you can get $250,000 versus maybe $90,000 with maybe some better tax benefits. It's the same thing with that millionaire. If you're at $1 million instead of $30,000 a year, what if you can live on $80,000 or even $100,000 a year off that money? Completely different life. Same money, don't have to work harder. And the truth is, and you guys know this because you guys have your own fund. You guys pay really better returns, or at least as good, if not better, than anything the stock market does when it's like this. It's all bipolar. It's all over the place. And you have to time it just right to jump out of the market. And nobody wants to jump out when it's at its high like it has been. People want to just kind of keep hanging in there. And then after it goes down for a few years, then they finally jump out after they've lost 20, 30, 40+% of their retirement portfolio. And now they're living on a budget, right? They can't afford to do anything else. And now they need Social Security to live. And the truth is, you don't need all that crap. That's just exactly what it is. It's a bunch of crappy advice to help put more money in the pockets of the financial institutions out there.
Yeah, it's to perpetuate what has been going on. Funneling money from you to somebody else. I mean, I remember it was probably more than a decade ago. I took a Dave Ramsey class, and I walk in and I'm talking to people, and I can't tell you how many people I talked to that said, yeah, this is my second or my third or my fifth class. I got financially free, but I'm back because I blew it again. And I'm like,
it's like AA.
It's like when I didn't finish the class. So when I heard that, I was like, this can't be right. It's this mindset that people are taught. It's the same thing about put your money in savings and, earn 0.25% while the bank gets your deposits and lends it out at 6%. And, and you can't outpace inflation. It's this whole mindset that people fall victim to. It's the way you're supposed to do it. It's these people who have letters behind their names. They're looking out for me. There's no one looking out for you better than you. And when you educate yourself through, like Money Ripples, Chris Miles, like you understand that passive income is the way to do it. And in real estate, there's other ways to do it, but we specialize in real estate, but real estate is by far our favorite.
Yeah, it's weird because I had that epiphany. I remember I was right before I quit being a financial advisor. I had gone to a training, and this is after Y2K had happened and everything, and it was coming back again. And they were talking about earning consistent rates of return versus fall in the market. Because they talk about average rates of return in the market, right? Like even Dave Ramsey still says you can make 10 or 12% in the stock market, which is 100% BS, 100%. Because the 30-year average, an actual yield, like if you put in the numbers, it comes up with the right numbers. The actual 30-year yield is about 8.3% right now in the S&P 500. That's before fees come out. That's before your taxes and everything else. Well, I remember seeing like average returns, like they talked about, hey, if you lose 50% of your money, you lose half of it. They asked us, they asked all those financial advisors in the room. There's probably at least 50 or 60 of us. The guy asked, the trainer said, if you lose 50%, what's the rate of return you need to get back to zero? And of course, we all said 50% because we're brilliant financial minds, of course. Because you got to be a brilliant financial mind to be a financial advisor, regardless of the fact that you just have to pass a test with 70% and have a heartbeat. So we all said 50%. He said, well, that doesn't work. Look at the math. Say you went from 100,000 down to 50,000. You get a 50% return. That 50,000 only earns 25. You're up to 75,000. You're still 25,000 short. He said, no, you don't need 50% return. You need 100% return because when you lose half, now you have to double, which is 100% return. He's like, you do that average, right? Minus 50 plus 100 is 50. Divided by 2 years is a 25% average rate of return, which is exactly the rate of return that every financial advisor uses. And it blew our minds. We're like, wait a minute, holy cow. Even, this is even worse if you're in retirement, because think about it. If you lose half your money and then you pull out 10%, right? Now you're down to 40% of that money, or maybe let's say 45 really, right? Because you take 10% of that, but now you need a way more than 100% just to get back to where you were, to get back to your old planning model. And it doesn't work that way, especially if you're pulling out money. It's actually dangerous. You could lose money faster, which is why in reality, a lot of people couldn't retire as easily during Y2K, moving into the Great Recession and so on. Some people, including my own father, postponed his retirement 15 years because the market just happened to turn right when he was about to retire. And so he went from hoping to retire in his mid-50s to retiring at about 70.
Wow. Well, and that's the part of the problem with rates being as low as they have been historically for the, we'll call it past 10 years. They've pushed people into more risky stock market investments, equities, companies that aren't even earning an income. It reminds me of the NBA draft. I'm drafting this guy either right out of high school or from Europe. He has all he has is upside. He's not proven anything. He's just big, strong, and fast. But he's got tremendous upside. Instead of drafting the person that you've seen the record, you know what to expect. It's the same thing that happens in the stock market. People are evaluating companies that have no earnings based on potential earnings. And if you're invested in all of that, and then suddenly interest rates go up and people start moving over into something a little more secure, or you have a black swan event, and all of a sudden those companies that had the potential no longer had the potential, you can lose a bunch of money. And it's really a shame. I'm actually looking at my own parents' portfolio, and they're in their mid 80s, and their guy had them at probably a third of their portfolio is in commodities. And like I said, mid 80s, why are they in commodities? They should be all in fixed income stuff if they're going to be in the stock market.
Sure.
It's about preserving the capital. And yes, you could hit a home run with commodities, but you can also lose everything.
That's right.
It makes no sense.
They've never been manipulated, right? We've never seen gold get manipulated by J.P. Morgan and resulting in a $1 billion lawsuit, have we?
No.
And so those $1 billion lawsuits, when they do pay off, are they paying back any of the investors that invested with them? No.
No.
It's just a penalty.
That's a slap on the hand, right?
Goes to the SEC, so they can penalize other people. You work a little bit differently on the banking side of things, where and I love this strategy where you can be your own bank. So we'll kind of backstep to Dave Ramsey. He is really good for the masses, like you said. When you're leveraging stuff that you want instead of leveraging stuff that makes you money, which is not really going into debt at that point, it turns into an asset. But most people get loans on stuff they want, not stuff that makes them money.
Yeah.
So
That's right.
Talk about the infinite banking a little bit for us, if you don't mind.
Yeah, I'll just a couple of things, because you mentioned obviously debt. What do I think about debt there? And overall, I love cheap bank money. I love utilizing that, especially if it's used to purchase more assets, right? That's the thing, especially if it's cash flowing assets that more than pay my payment on that debt. It's funny because I worked with a lot of business owners, and when you look at the common sense, they get it. They get it completely. Because if you're thinking of from a business mode, you're saying, hey, I got my SBA loan I got from the bank, whatever it is, to start up my business. Your hope is that whatever you put that money into in your business is going to come back to pay at least that payment and keep you profitable, right?
Sure.
So it makes perfect sense from a business standpoint. But oh my goodness, from a personal standpoint, you get debt, that's bad. But from a business, I remember my first SBA loan was $25,000. The minimum monthly payment was about $130 a month. Now, if I'm in business and I can't turn 25 grand into $130 a month, I shouldn't be in business, right? I'm a complete failure in that case. But obviously, I want to be making at least $1,000 a month, hopefully, with that 25 grand, if not a couple thousand or more a month. That's exactly how you should look at it from a personal standpoint too. If you leverage loans and debt, is can I create that arbitrage, that difference between what I have to pay and what I'm actually earning, just like the bank does with us when they borrow money from us, at a certain rate, and then turn around and loan it back to us again as car loans, home loans, and everything else, credit cards or whatever it might be. And you look at it that way, debt's kind of crazy, because you never hear a bank call you up saying, I need to pay off my debt to you, because the debt that you have to the bank's debt is a savings account.
Right.
So have you ever had a bank call you up, said, hey, Mr. Bill, Mr. Fairman, you've been with us for the last 40 years. You've been such a great customer, but you know what? We've been watching the Dave Ramsey show recently, and man, got to tell you, debt is bad. We got to get out of debt. Cash is king. So we're going to pay off your savings account. We're going to cash you out because we don't want to be in debt to you anymore because we don't like paying that interest. Because have you seen what that interest costs over time when it compounds? It's like $300 out of that 100,000 you put in there over 500 years. You never hear a bank call you up to do that. They're more than glad to take your money and they want you to keep putting it in. In fact, they're part of that conspiracy. It's really a very open conspiracy of, hey, give us your money so you can let it sit on a shelf, but we're not letting it sit on a shelf. We're going and using it to create cash flow and create income and create profits from your money while you're sitting fat and happy thinking you're doing just fine, watching your Bachelor again, thinking, hey, I'm good because I just made, $2 this month in interest on my huge savings account.
It's the false feeling of safety that they've created for people.
That's right. Security and freedom are in opposition to each other, right? That security, thinking you're safe and secure, is not going to create any freedom. And that's the problem that's there. So that's my little rant about debt, is that debt can be used wisely if you're a wise steward of your money. If not, if you're going to blow it, like you said, if you're going to blow on personal consumption, it's a bad idea. But if you're going to use it to actually buy legitimate, really secured, real assets that you're going to buy, and they cash flow and they create more the income than what you're having to pay for that money, great. It makes perfect logical sense. Now, what you're talking about too is like there's this other concept called infinite banking, right? Which is utilizing it a little bit differently, but it's somewhat the same, but it's kind of like debt that pays you back and then some, right? Because what you're actually doing, you're utilizing whole life insurance. For those that don't know what that is, there's term insurance, which is just a death benefit. That's what most people get. You only get the money if you die. But when it comes to the whole life insurance, you have the death benefit, but you also have this tax-free savings account inside of it that can grow. The problem is that most people that talk about infinite banking, the reason why it has a bad rap, even with Dave Ramsey and Susie Orman, is that usually they're very expensive. They take most of your cash, if not all of it, up front. And then finally, over many, many years, you finally build up enough cash of what you've paid into that premium. You finally make that money back. It could take sometimes 15, 20 years to make your money back. I agree with Dave Ramsey and Susie Orman. Those kind of whole life policies suck. Do not get those policies. They're horrible. I like policies where the big bulk of the money that I put into it, that first year alone, which is the most expensive year, actually goes in that cash tax-free savings account. Now, you got this kind of savings account, you can do the same thing you can do with a bank account. Because you probably don't realize this, but if you have a savings account in your bank, you can walk in today to your banker and say, hey, can I get a cheap line of credit against my savings account with this bank? And the banker will say, well, yeah, all we'll do is we'll just, give you the money, lock up your savings so you can't touch it. But if you ever miss payments, we'll just take the money out of the savings account, right? So they have your savings account as collateral at that security, and they give this collateralized line of credit that you can go and leverage and use. Now, the only problem is you're going to be paid 0.nothing% on your savings account while they're, charging maybe at least 2, 3, 4% for that money. But with the life insurance, you can get a much better spread, a much better deal. Because the life insurance, you can be earning at least 4, 5+% tax-free on your money while it's sitting there in that account. But then you get a line of credit against it, anywhere from 3 to 5%. So you're making money here higher than what you're paying on the loan versus the bank. If you get the savings account, it's the opposite, right? But here you can be making more money than what you're paying on the loan. And then you take that money and you could just blow it if you want to. You can use it for whatever you want. But what you're actually going to do is take this money and go and invest it into creating cash flow, into these cash flowing assets. So example, if you have, say, $100,000 in here, you get a $100,000 line of credit against it. Great. You're still making interest here where you're making more than what you're being charged. But now you can take that $100,000, go do an investment, say you only made 8%. Well, now you're making $8,000 a year, plus you're still making a spread on this. You can probably make another couple percent over here. So you actually made, instead of just 8%, you made 10% off of that same money that you wouldn't have done if you just use a savings account. You liquidate the account, you take out a savings, throw in the investment, you get paid the 8%. But here we double dip and make money in two places at the same time.
And I hate to use that for consumption, but even if you needed to go buy a car, and you borrowed against that policy, you're paying yourself back the same interest that you would pay to the bank. So you're only paying yourself back, and at the same time, the account is earning tax-free, you're still getting a spread, because even if you paid, equal parts interest, you're still making more money in the policy because you don't have that tax, that the interim tax that's coming out either.
That's right. Yeah, you're making all that money in there tax-free. Now, to be clear, you still are paying back a bank, right? And that's the one thing that many of those infinite bankers will teach as a myth. They'll say, oh, you just pay yourself back interest like it's a 401k. You really don't. But what you are doing is you pay it back. You are paying the interest to the bank or the insurance company, whoever you get that loan through. But as you pay the line of credit down, less and less is being charged to interest, just like you would if you did it on a home equity line of credit. If you pay down more than just the interest only payment, it brings that balance down, charging you less and less. So
but
that's the key
difference. At the same
difference.
time, you are paying who you're essentially giving you the line of credit, but your money that's still in the account is earning at or near what it is you're paying anyway. So
exactly.
Well, you say because you get more benefits from it too.
Exactly. Yeah. Use the example, say that we did 100,000 loan, but say you had 200,000 in there. Normally, if you just withdrew money out of your savings account, your 200,000 becomes 100,000. That's what you earn interest on.
Right.
But the life insurance, if you have 200,000 a year, you don't touch that money. It's still earning interest on that 200,000 tax free. And then you're just taking that line of credit, 100,000 out, using that however the heck you want. You can buy whatever. You can use it for emergency fund. You can use it for college savings. You can use it for helping your kids if they decide not to go to college, because that's why people hate 529 plans. They're inflexible and they're gambling in the stock market. Some people say, great, I have a 15-year-old wants to become an entrepreneur. Cool. Help them with their first business. You can use this money for whatever the heck you want, and you don't have to give a reason. Unlike most bank loans where you have to say, here's why I have to do it. Mom, dad, can I have the car keys? Thanks. That's you don't have to do that with this kind of thing.
Yeah.
One little thing I want to add to on the whole life policies like this. If you set your family up as a family office, we'll just call it a family office. One of the things that I think it's in the Rockefeller habits, it might be a part of, but typically when you have a family that earns a great deal of money, we'll compare the Vanderbilts and the Rockefellers. Rockefellers still have money, Vanderbilts not so much. And typically what happens is about the third generation of a family, they end up squandering all their wealth. And there's many factors for this. My particular opinion is that the family that created the wealth, they have good work ethic and they know what they're doing. Their kids understand the work ethic because they were raised by those direct parents. It's usually the children of the parents. The children of the children are the ones that ruin it. But what they've done is every child that's born in the family, they take out a whole life insurance policy on them, and then they make it the beneficiary, the family office. And that way, even if you're a ne'er-do-well and you pass away, you're at least contributing something back to the family estate. So that makes a lot of sense there as well. And
it's a way to keep that money funding and growing, right?
Right.
Mm-hmm.
And then that's more to add to borrow against and buy new assets that are cash flowing.
Right. Yeah, exactly. It's the same thing that GE did to pay their pensions. Back in the day, when we used to have companies that paid pensions, right? GE did the same thing. They figured out that little trick. They said, well, we can buy a whole life policy on our employees, because as a business owner, a business can buy on their employees. Walmart did the same thing, but they started getting busted by the families because the families didn't have, the husband didn't bother, or the wife didn't bother getting the life insurance on themselves. So the only person that ended up getting paid sometimes was Walmart.
Right.
But GE would do the same thing. They would buy a policy on their employees. And then after they were there, they would use that cash value to help pay their pensions. Well, when that person passed on, that death benefit, of course, went and paid into that pension fund, building it right back up again. So then they could turn around and do it again with their pension, and they just kept that money growing and going. And same thing here. But as a family, you can do all kinds of terms with it. You could say, well, in our family trust that we have set up, rather than just pulling that money out, like you said, it's gone by the third or fourth generation. Thanks, Paris Hilton. She might be the one that keeps it going for the Hiltons. Maybe, I don't know.
We'll see.
But I had a client that was a great granddaughter of the Marriotts, and you could already tell the money had already like dispersed and kind of dissolved and became less and less. She was inheriting $50,000 from the Marriott dynasty.
Wow.
Whoop-de-doo. But it's the same thing here. Is that you could have it set up to you say, no, you can't just get this money. We're going to actually have you go to the family bank. You're going to have to borrow from it, and for whatever it is, maybe you come to us almost like a bank for a loan. But we're going to charge you interest so that you pay this money back into this estate, so that it keeps the money and the wealth growing within the family versus just, piddling out at some point.
Yep. Exactly.
Yeah. And you set yourself up a little loan committee. And if you don't pay the last loan, you're not going to get a new loan until you change your ways or prove that you've changed your ways. So it'd be like any other business. And that's the way to do it. There should be consequences to those actions, but we could talk about this stuff for days.
I know,
right?
I love it. Yeah.
Absolutely.
Chris, I really appreciate you coming on the show. I want to make sure that we get your URL up. Shrew, you mind putting that up there? Thank you so much.
Worked.
MoneyRipples.com. Now, Chris is an author. He's been on CNN Money. He's been on U.S. News. He's been featured on Bigger Pockets. He's got a great podcast. What's the name of that podcast, Chris? Is it?
It took me forever to come up with the name, but it's called the Chris Miles Money Show.
Yeah, you dug deep for that one.
Yeah. Sadly, it was actually other followers that came up with the name. I didn't come out with it with my own head. So you can tell what the brilliance is. It's in the listeners.
Yeah.
You have some awesome content in your podcast. So I encourage everyone to follow Chris's podcast as well. Once again, thank you so much for being on the show.
Thanks.
Folks, thank you for joining us. This is what's the name of our show again? The Real Estate Investors Show. We are hard money for real estate investors. So if you guys are interested in a loan, because we are Carolina Capital Management and we are lenders in the Southeast for real estate investors. If you're interested in borrowing money, go to carolinahardmoney.com and click on the Apply Now tab. If you're a passive investor looking for passive returns, click on the Accredited Investor tab. Don't forget to like, share, subscribe, hit the bell, and don't forget to sign up with Wednesdays with Wendy. We'll see you guys next week. Have a great day.